Hello, everyone. Thank you for joining us for today's Financial Issues Forum featuring Edward Chancellor speaking on his new book, The Price of Time, The Real Story of Interest. I'm Jim Kelly, Director of the Gabelli Center for Global Security Analysis at Fordham University. On behalf of the Gabelli School, welcome. The Financial Issues Forum, organized by the Gabelli Center and our wonderful co-presenters, the Museum of American Finance and the CFA Society of New York, has sponsored more than 70 events since 2020, which have drawn approximately 10,000 attendees. We are very proud of this dynamic collaboration, and a full archive of our video content will be shared in the thank you email that you will receive. Mr. Chancellor will speak for about 30 minutes, followed by Q&A led by David Cowan, President of the Museum of American Finance, and Richard Silla, former chairman of the museum and professor emeritus at NYU. Please submit your questions through the question field that is located at the bottom of the video player. Please feel free to submit questions at any point during our event. We will be addressing as many of them as possible during the session. All attendees at today's event will be receiving digital copies of Mr. Chancellor's book, with information coming to you following our event. And now I'm delighted to turn it over to David Cowan to introduce our speaker, Edward Chancellor.
Thanks, Jim. Good to see you and our audience again. Our author started history both as an undergraduate at Cambridge and then as a graduate student at Oxford. He's had a dual career working on Wall Street at firms like Lazard and Grantham Mayo, but we know him best with his work with a pen. He's an award-winning journalist where he's published articles in Reuters, The Institutional Investor, Wall Street Journal, the Financial Times, just to name a few. His first book, published in 1999, Devil Takes the Hindmost, A History of Financial Speculation, made the list of New York Times notable books of the year, and it stands the test of time. And I know this personally, as Dick Silla and I still use it regularly in the Fordham class that we collaboratively teach called Booms, Bubbles, Busts, and Crashes. The book that Edward wrote detailed about the constant speculation with bad endings, and within a year of publishing it, we had the dot-com bust. Again, showing predictive powers in 2005, he wrote Crunch Time for Credit, laying out the excesses that reared their ugly head within a few years with the 2008 credit crisis. His current book, The Price of Time, recently won the 2023 Hayek Book Prize from the Manhattan Institute. You can get more of Edward, including podcasts and videos, on his easy-to-remember website, edwardchancellor.com. Now, adding up his career, he certainly deserves the recent accolade from Fortune magazine as quote-unquote one of the great financial historians alive. And so let's find out from Edward what's so interesting about interest in any new predictions based on the book. It's my pleasure to turn it over to Edward Chancellor.
Well, David, thank you for that introduction, and thank you for having me here today. And I'm pleased to say that we've got an even more distinguished financial historian, Dick Silla, who will be answering and perhaps asking a few questions when I get to the end of my talk, which gives me a reason perhaps to end sooner rather than later. I'm going to talk to you about the question of interest, which, according to the great Austrian economist Eugen von Bern-Bawerk, who wrote a 3-volume book called Capital and Interest in 1884, von Bern-Bawerk wrote, "The question of interest has long been the object of contemptuous neglect." I'm afraid to say that in the 140 years since he wrote that, the neglect has deepened, in fact, has become a sort of blanket neglect. And the aim of my book is to expose the importance of interest, because in my view, you cannot understand economics, and you can't really act effectively as an investor unless you understand the importance of the role of interest. When I was writing this book, people, I'd mentioned I was writing a history of interest, people's eyes would roll with boredom, and they thought the subject of interest was obtuse and uninteresting. But I don't think that's the case. And perhaps one way of illustrating that is from an extract, a quotation from one of my favorite writers, the Indian novelist R.K. Narayan. This is from his novel, The Financial Expert, which describes the antics of a moneylender called Margaya. Here's Narayan. There was probably no other person in the whole country who had meditated so much on the question of interest. Margaya's mind was full of it. Night and day he sat and brooded over it. The more he thought of it, the more it seemed to him the greatest wonder of creation. It combined in it the mystery of birth and multiplication. Otherwise, how could you account for the fact that 100 rupees in a savings bank became 120 in the course of time? It was something like the ripening of corn. Every rupee, Margaya felt, contained in it the seed of another rupee, and the seed in it another seed, and so on to infinity. It was something like a firmament, endless stars within each star, an endless firmament, and within each one further endless. It bordered on mystic perception. It gave him a feeling of being part of an infinite existence. Now, the history of lending or usury has had more villains than heroes, and Narayan's Margaya is one of the villains. An avaricious and mean-spirited moneylender, he lures peasants into borrowing too much at rates they cannot afford to pay, forecloses on their properties, and becomes in the process very rich. And towards the end of the book, he changes tack and starts drawing in deposits by offering extremely high rates of interest, which he cannot afford to pay. In effect, he's running a Ponzi scheme. And Margaya eventually goes broke, which in the novel at least offers him a chance of redemption. Now, the criticisms of lending at interest, as Narayan is showing, are actually age-old. In ancient Hebrew, one of the words for interest is neshek, meaning the bite of a serpent. In Lagash, in Mesopotamia, in the third millennia BC, aristocrats lent at such high rates of interest that borrowers lost their land and sometimes their freedom too. Debtors weighed down with interest suffered similar fates throughout the ancient Near East. Margaya marvels at the compounding of interest, what Einstein reportedly called the eighth wonder of the world. In fact, this comment originated with a US investment firm in the 1920s. Compound interest at high rates in an economy with low growth is a terrible thing. The first record of compound interest, also found in Lagash in Mesopotamia, is a dispute with a neighboring territory over unpaid rent over a period of decades, compounding at 33% a year, leading Lagash to demand 4.5 trillion litres of barley, roughly equivalent to 6 times the current US barley production. Richard Price, an 18th century English statistician, calculated that a penny put out at 5% compound interest at our Saviour's birth would by this time, that is, in 1773, have increased to more money than would be contained in 150 millions of globes, each equal to the Earth in magnitude, and all solid gold. Just about everyone has had a go at attacking interest over the years. Ancient philosophers, religious scribes, medieval scholars, Marxists, Marx himself, fascists, Hitler, and even the contemporary Archbishop of Canterbury, who launched the war on Wonga a few years back, Wonga being a payday lender. the Greek philosopher Aristotle's critique has been most influential. Usury, he said, was immoral because money was intended to be used in exchange, but not to increase at interest. This view that charging interest was unfair because the lender demanded back more than he gave was taken up by the church fathers and later by the medieval church in Europe. But there is something lacking in Aristotle's comment, the factor of time. Lending takes place over time. This point was picked up by a 14th century English theologian, Thomas of Cobham. Now, Thomas of Cobham held conventional views on usury, which he describes as a sin of avarice, that is, cupidity. And like Aristotle, Cobham claims that money that lies fruit money that lies fallow does not naturally produce any fruit, but the vine bears fruit naturally. However, Cobham rectifies Aristotle's oversight. The usurer, he says, is selling time. This doesn't lessen the crime in his view, since time belongs to God, and therefore he cannot therefore make a profit from selling someone else's property. A few centuries later, another Englishman, Thomas Wilson, took up the idea of the usurer as the seller of time in a vicious ranting tract called The Discourse Upon Usury, published in 1572. Wilson likens the usurer to hell insatiable, the sea raging, a cur dog, a blind mole, a venomous spider, and a bottomless sack, whereby you may well be assured that the devil dwelleth tabernacled in such a monster. Usury is as great an event, he says, as murder, adultery, and theft. Usurers devour whole kingdoms and deserve nothing better than death. And then he goes on, marry, to be a time seller, to gain days, months, and years, and to make the sun shining, which God sendeth so freely unto us, to be the fruit of your occupying, and to make money of money for the act of lending. These dealings, I do say, are most abominable in the sight of God and man. The difference between Wilson and Bishop Cobham is that Elizabethan writer is aware that his contemporaries considered time to be valuable. They say, writes Wilson, they say time is precious. He may well say time was precious to him that paid so dearly for it, or rather the usurer may say that time was very precious to him that took so much unto him. Wilson then goes on to provide a new definition of interest. Usury is also said to be the price of time, or of the delaying or forbearing of money. And the price of time is the title I took for my history of interest. Now, if you believe that time belongs to God, as both Thomases did, then usury or interest is clearly illegitimate. However, if you believe that time belongs to man and time is valuable, an altogether different picture emerges. A fragment of the Greek orator Antiphon in the 4th century BC states the most costly outlay is time. 5 centuries later, the Stoic philosopher Seneca the Younger reminds his friend Lucilius in a letter that time is precious because man is mortal and his days are numbered. Embrace every hour, he advises. The stronger hold you have on today, the less will be your dependence on tomorrow. Unlike Thomas of Cobham, Seneca doesn't believe that time is God's property. All sensual man, because untouched, unseen, he looks on time as nothing. Nothing else is truly man's, writes Seneca. Now, Seneca, incidentally, was himself an avaricious usurer in the manner of Margaya, who lent his vast fortune, super rich Seneca, they called him in Rome, at interest, and whose calling in loans to Britons was said to have sparked Queen Boudicca's revolt, the famous revolt of the early Britons against the Roman rule. Seneca's notion of time as man's most precious possession resurfaces in the Renaissance and is, of course, found in Ben Franklin's advice to a young tradesman. Time is precious, time is money, time is the stuff of which life is made. Franklin goes on to overturn Aristotle, offering a modern capitalistic view of money and interest. Money, writes Franklin, is of a prolific, generating nature. Money can beget money, and its offspring can beget more, and so on. So why is time valuable? Because, as Seneca observed, man is mortal. Time is running out. Man is naturally impatient. He values his present enjoyments over future ones. He requires some compensation to forbear current pleasures. Interest reflects what the great American economist Irving Fisher calls crystallized impatience. Even earlier in the 18th century, the French economist Henri Robert Turgot, who was also French finance minister, argued that a bird in the hand was worth two in the bush. A sum of money today and the same sum in the future couldn't possibly have the same value by this reckoning. For Turgot, interest was the price given for the use of a certain quantity of value during a certain time, or the difference in value between current and future money. Now, time value or impatience is vividly demonstrated in an experiment known as the marshmallow test from the 1960s, when the Stanford psychiatrist Walter Mischel tempted school children with the offer of a single marshmallow to be consumed immediately, or two marshmallows if they waited a certain period of time. As it turns out, many children waited to get the second marshmallow, and then studies found that the children who exhibited more restraint, waiting for the interest on their marshmallow, went on to have more successful careers. The time value of money exists in all societies and in every type of economy. It is especially important in what we call capitalism. In France, until the 18th century, the word for interest was synonymous with capital. In fact, what we call capital only has value because it produces a future stream of income that is discounted using an interest rate back to a current value, or a current present value. Interest rules the world, as the 17th century philosopher and statesman Lord Shaftesbury wrote, in a slightly different context. Now let's consider a few of the functions of interest, starting with valuation. The time value of money shapes our world. As John Law, the early 18th century gambler, economist, and projector wrote, anticipation is always at a discount. £100 to be paid now is of more value than £1,000 to be paid £10 a year for 100 years. Without a discount rate, an apple in 100 years' time would be worth the same as an apple today, which is an obvious absurdity. The discount rate or capitalization rate is an essential input into any act of valuation. Lower interest rates result in higher valuations and vice versa. Now, Adam Smith noticed this when he, in The Wealth of Nations, that was published in 1776, he observed that as interest rates had declined in recent years, in his day, the price of land had gone higher and higher. And the same phenomenon can be seen around the world over the last decade or so, as mortgage rates sank ever lower, until recently, that is. Now, John Law, who we've just heard about, conducted an interesting experiment with interest rates back in France in the 1710s. Law founded France's first central bank, the Banque Royale. He also created a massive holding company that we know as the Mississippi Company. The Banque Royale Mississippi Company acquired all the France's outstanding debts that were indirectly financed by the central bank. Now, I argue that Law's project or system is the world's first experiment with quantitative easing. Now, Law's aim was to lower interest costs in France. At the middle of the decade, they were about 8%. At the peak of Law's scheme, they'd fallen to below 2%. The stock price of Law's Mississippi Company went from 500 livres to nearly 10,000 livres, an increase of 20-fold in a very short period of time. Now, at the peak, the Mississippi Company shares had a dividend yield and also price earnings ratio, because all their profits were paid out, of exactly 50 times, which is a 2% dividend yield or 2% earnings yield. And Law argued at the time that the high price of the stock was justified by the low prevailing rates of interest. Well, this didn't last very long, and Miss Law's system became unstuck, and the Mississippi Company later, its stock crashed, and Law's scheme was abandoned. But it shows you very clearly the relationship between interest and asset prices. And in my view, all great speculative bubbles in history have occurred at times of easy money, from the tulip mania of the 1630s through to the current day. Up until last year, interest rates, as you probably know, were at their lowest level in history, resulting in what we call the everything bubble. Bubbles in stock prices, US stocks, tech stocks, meme stocks, special purpose acquisition companies, in real estate around the world, and a variety of other assets, venture capital, cryptocurrencies, non-fungible tokens, and vintage cars, call it what you will. Ultra-low rates created an extraordinary illusion of wealth, what I call virtual wealth, turning the real economy into a bubble economy. It was, as Warren Buffett's partner Charlie Munger said in 2020, the most extraordinary period in financial history. Now, as inflation has returned, interest rates have been rising for the last year or so, and asset prices have been falling. Last year, some $30 trillion worth of wealth evaporated from the stock and bond markets. I read a comment the other day from the former SPAC king, Chamath Palihapitiya, whose aim was to launch a SPAC with every initial of the alphabet, starting with A, B, C, D, E. I'm not quite sure how far he got. Anyhow, what Chamath said the other day was the mathematical truth of higher interest rates is that it renders your company valueless. Well, that's not true of all companies, but it renders the most speculative companies valueless. Interest also influences the allocation of capital. Production takes place over time. And the level of interest influences the length of production processes, or what we call the payback period or hurdle rate for new investments. When interest rates are high, investors demand a quick payback, and when low, a longer payback. The 19th century American economist, who was also head of Yale, Arthur Hadley, linked interest to the survival of the fittest. Interest, Hadley said, helps the natural selection of the most competent employers and the best processes, and the elimination of the less competent employers and the worst processes, what he called the industrially unfit. Interest thus spurs what Joseph Schumpeter called creative destruction, and what Schumpeter saw as the essential feature of capitalism, by driving capital from low return businesses to higher return businesses. As James Grant, the financial journalist and historian, writes, interest sets the tempo of production. At higher interest rates, there's a higher price on time, and things move more quickly. Ports in the Middle Ages, and even today, imposed what they called a demurrage charge on ships for dawdling too long in harbour. Interest on loans is another kind of demurrage charge. In my view, the ultra-low interest rates of recent years have thwarted the process of creative destruction, slowing the tempo of production. We witnessed the appearance of so-called zombie companies, inefficient companies whose low returns on capital serve to undermine productivity growth. Furthermore, capital has flowed indiscriminately into long-dated investments, principally real estate around the world, and into venture capital on Silicon Valley, which has financed ever more preposterous businesses, autonomous cars, space tourism, and lately crypto ventures, such as Sam Bankman-Fried's FTX exchange, which turns out to have been a fraud. Silicon Valley investment over time has really turned into a silly con, so to speak. Now, interest also influences risk-taking. The 18th century Italian intellectual, Ferdinand Galiani, described interest as what he called the price of anxiety, or what we would call the price of risk. Galiani reasoned that all lending produced anxiety in the part of lenders for which they needed compensation. Put another way, interest is like an insurance premium paid out against the risk of loss. What we find is that extremely low interest rates offer an inadequate protection against loss. Furthermore, they induce investors to take more risk to maintain their income. This was well understood by the great Victorian journalist Walter Bagehot, who wrote that John Bull, and John Bull is the eponymous Englishman, normally an embodiment of good sense. John Bull, wrote Bagehot, can stand many things, but he cannot stand 2%. Faced with 2%, John Bull will do silly things with his savings. It is a fact of experience, wrote Bagehot, that when the interest of money is 2%, capital habitually emigrates, or what is here the same thing, is wasted on foolish speculations which never yield any adequate return. And elsewhere, Bagehot writes, if the old and tried and safe investments no longer yield their accustomed returns, we must take what they do yield or try what is untried. We must either be poorer or less safe, less opulent or less secure. Now, modern research confirms Bagehot's intuition. Easy money encourages yield chasing that leads to a decline in underwriting standards. Consider, for instance, in recent years, the provision of so-called covenant-light loans, loans made to private equity, to leverage buyouts that didn't contain the traditional covenants intended to protect the creditor. And as a result of that, one also has rising financial risk. One measure of financial risk is leverage, debt relative to equity or capital. Interest is also the price of leverage. Thus, it appears that households, companies, and governments target a stable debt service ratio. As the interest rate declines, they take on more debt. In the UK, where I'm based, for instance, the average household mortgage to income ratio is around 2.5 times its level in the early 1980s. What that means, according to one housing analyst, is that a 3% interest rate in the UK today is the equivalent as a 14% rate of interest, mortgage rate in 1983, because households have so much more debt that even a relatively small interest rate is enough to consume a large share of their income. Government debt levels around the world have soared since interest collapsed during the global financial crisis. Ultra-low interest rates have also encouraged what we call financial engineering, as companies use debt to enhance returns, buying back shares rather than investing, and acquiring other companies. Leverage buyouts have proliferated. A corporate takeover boom funded with low-cost debt has contributed to the growth of monopolies, with all their attendant ill effects. Global debt levels today are far higher than at the time of the financial crisis. As interest rates rise, over-leveraged entities are struggling. And we've seen that in a number of different ways, which I'll address towards the end of this talk. Interest also affects savings. It was described by an early 19th century economist, Nassau Senior, as he was called, as a reward for abstinence, or what we would call an inducement to save. Interest compounds the rate at which savings grow, enabling us to retire at some stage. Ultra low interest rates punish savers. The Germans felt this in particular, having most of their financial assets on deposit rather than in stocks like the Americans and the British. And in the last decade, the German finance minister, Wolfgang Schäuble, attacked the low interest rates of the European Central Bank, calling them Strafzinsen, which means punishment rates. Without an inducement to save, savings rates in Britain fell in recent years to the lowest levels on record. People were deluded into believing they could live in retirement off the wealth effortlessly accumulated in their homes. Pensions found that lower interest rates increased the value of their liabilities. Defined benefit pensions, which pay a certain guaranteed income on retirement, have more or less disappeared, except in the private sector. And existing pension plans were forced to take greater risks to boost their incomes, or went into the derivatives markets to buy long-dated bonds. In Britain, this led to the collapse of the near collapse of the UK pensions industry in September of last year, when the major UK pension funds were discovered to have leveraged long-dated UK index-linked bonds up to sixfold, with footings apparently of more than $1 trillion. Now, the bonds they were buying at the time yielded negative, I think, 2%. Those bonds then declined 85% in value and to a redemption yield of just 1%. And so 1% historically is an extremely low real yield on a long-dated bond. But a 1% yield on these long-dated bonds, as I say, was just about enough to cripple the pension funds, and had they not been bailed out by the Bank of England, to have induced a severe crisis in the city of London. Interest is always a question of the distribution of income and wealth. I started this talk mentioning the moneylender Margaya, who, charging too much interest initially, takes wealth, money and wealth, from those who borrow from him. And that is the sort of basis of the critique of interest. And consider Karl Marx's denunciation of usury in ancient Rome, which he says consumed the entire surplus, enabling patricians to suck dry and enslave small producers and peasants. Usurious capital, wrote Marx, impoverishes the mode of production, paralyzes the productive forces instead of developing them, and at the same time perpetuates the miserable condition. Usury, Marx continued, does not alter the mode of production, but attaches itself firmly to it like a parasite and makes it wretched. It sucks out blood, enervates it, compels reproduction to proceed under ever more pitiable conditions. Now, if you were listening, you'll notice that from what I've said already, that I disagree with Marx's comments that usury or interest does not alter the mode of production, because in my view, it clearly does. But such anti-usury views continue in the writings of the modern economists, specializing in inequality, such as Thomas Piketty, the best-selling author, the French economist and best-selling author of Capital in the 21st Century. I might add, meanly, that this book, like Stephen Hawking's Brief History of Time, was a book more bought than read. The world became obsessed with the issue of inequality. President Obama called it the most pressing issue of our age. Pope Francis weighed in. My own take is rather different from Piketty's. In my view, ultra-low interest rates benefited the haves at the expense of the have-nots. The haves are those who owned their own houses, owned stocks and shares, who ran private equity firms, who worked on Wall Street when all these mega deals were going by, who worked for investment firms, whose fees and profits rise along with the stock market. As interest rates sank, wealth inequality rose. In my book, I have a chart showing that the wealth of the top 1% of Americans has roughly moved over the last half century, inversely to the yield, has moved in line with the total return on long-dated bonds. A pretty good demonstration, I think, of the relationship between falling interest rates and rising wealth inequality. US household net wealth rose to an all-time high at the end of 2021, roughly 100 percentage points relative to GDP above its long-term mean. Bankers, hedge fund managers, senior corporate executives have earned fortunes thanks to their access to cheap capital and the inflated asset prices resulting from ultra-low rates. However, if you didn't own a house or other investments, low rates made it more difficult to get onto the housing ladder or to acquire savings for investment. It's a little-known fact that the less well-off keep much more of their wealth, or a much greater percentage of their wealth in cash, which they must do for precautionary purposes in case they lose their job, and thus suffered most from the decline in deposit rates. To make matters worse, their own cost of borrowing for the least creditworthy than the poorest sections of society didn't fall after the global financial crisis, but actually rose as banks tightened lending standards to so-called subprime borrowers. A double whammy. Thomas Piketty's book contained the famous equation that inequality rose when R, the rate of return, was greater than G, the rate of growth. Now, the notation R is conventionally used in economics to stand for the rate of interest. My own formula, which has yet to catch on for some reason, is the reverse of Piketty's. In other words, inequality rises when R is less than G. My position is supported historically by the fact that the appearance of the richest people in history has occurred at times when interest rates were at a low ebb. For instance, Jakob Fugger, the German banker in the early 16th century, our friend John Law in 18th century France, J.D. Rockefeller in the Gilded Age, and Elon Musk today. Elon Musk and Bernard Arnault, the French owner of a suite of luxury goods companies. Income inequality in the US over the past 4 decades, as I say, has roughly tracked the decline in treasury yields. Well, what are we to make of all this? First, that like it or not, interest or time preference is an indispensable, unavoidable part of the human condition. It has been around since the dawn of history and will always be with us. Interest is essential because it allows people to transact over time. Second, whether we know it or not, interest enters into every calculation, as Joseph Schumpeter said. It is, as Irving Fisher said, an omnipresent phenomenon. And Karl Marx, who I don't think probably understood interest, nevertheless has a perceptive comment when he says that usury lives in the pause of production, as it were, just as the gods of Epicurus lived in the space between worlds. Interest, says my friend Jim Grant, is the universal price. And as the Harvard economist Jeremy Stein and brief one-term Fed governor wrote, interest gets into all the cracks. Third, capitalism as an economic system cannot function without interest. As we've seen in recent years, the disappearance of interest has been associated with the appearance of asset price bubbles, rising financial risk, and the weakest period of economic growth since the Industrial Revolution, a period in which interest rates, you won't be surprised to know, were at decently healthy and positive levels. If you attempt to do away with interest, you must accept a planned economy. But remember that one reason the Soviet Union failed was because the system lacked interest rates to guide the allocation of capital. Fourth, the period of ultra low interest rates has left the financial system and economy in a perilous state, in a state of what you might call intertemporal disequilibrium. Last year, we saw, as I mentioned, the UK pension plans almost explode. We saw the collapse in the crypto world and the implosion of the fraudulent FTX crypto exchange. And then this year, we've seen the eruption of a regional banking crisis, a banking crisis that was induced by the Fed raising interest rates. And so banks like Silicon Valley Bank, which owned a portfolio whose assets were largely comprised of US treasuries, which, if you remember, normally defined as a risk-free bond, that the losses, Silicon Valley Bank's losses on risk-free treasuries bought at ultra-low yields were enough to induce a run on the bank and then a regional banking crisis. In my view, this process is not over yet. There are commercial real estate loans to come through, many of which are turning sour. Around the world, real estate markets are falling. I mentioned earlier that 3% mortgage rates in the UK were equivalent to 14% back in the early 1980s. Well, now mortgage rates are back up to 6 or 7%. And housing markets around the world, perhaps in particular the greatest risk is China, which has experienced since 2008 the biggest, in my view, real estate bubble in all of history. Those real estate declines are likely to continue. And given, as I say, that interest gets into all the cracks, it means that we don't quite know where all these cracks are and where all the prospective problems are to be found. So with that thought, I will end my talk, and I look forward to your questions and to a discussion with Dick Siller.
Thank you, Edward, for that whirlwind tour through the ages of interest. And we're joined, as mentioned, with Professor Siller. So, Dick, why don't you take the first question?
Okay, well, I'm going to ask one of my own questions. I don't see so many popping up on the chat yet, but
I've got a couple.
Oh, you
I can say, yeah.
Anyway, I think you sort of just answered, Edward. My first question was going to be that, the background is that we see these same things repeat themselves over and over in financial history. Certainly your first book, Devil Take the Hindmost, was a good account of how we see the same things over and over. I was thinking, reading your book, that you mentioned in the latest book that Japan in the 1980s reduced interest rates in the late 1980s in order to prop up the US dollar, which was falling in value. And of course, that produced the Japanese bubble, that produced a crash in Japan, and then they had a period of deflation and a couple of lost decades. You also mentioned briefly that in the 1920s, the U.S. did the same thing to help Britain prop up the pound. In the late 1920s, the U.S. Fed reduced interest rates to help Britain maintain the value of the pound. And of course, that led to the Wall Street bubble, and then the crash, and then a period of deflation. So just lately, we've had the U.S. and really everywhere reducing interest rates to prop up the economies hit hard by the global financial crisis and the COVID crisis. And I think you just referred to that, but we've already seen some negative effects, which you just referred to. But I guess my question is the worst yet to come? Are we going to see, uh, something worse happen in the period ahead?
So yeah, to go back, so historically and more recently, I think the overwhelming problem with setting interest rates has not been the question of, say, the US helping support sterling in the 1920s, or Japan supporting the dollar after the Plaza Accord of the mid 80s. It's rather that the central banks have taken as their proxy for a fair rate of interest the rate of interest that is uh, that is congruent with a stable price level or low inflation. And one of the arguments of the book is that it's very difficult to tell that inflation alone won't tell you whether you've hit the right interest rate or not. And I think so the Japan's bubble economy uh, occurred at a time when inflation initially was at very low levels, and likewise in recent years, obviously after the global financial crisis, there were these deflationary pressures in the wake of the financial crisis, and that was an inducement to keep interest rates low. And I think the authorities took it too far. Question: where are we? So one thing I've observed I've been writing about. I suppose I've been I started writing the Devil Take the Hindmost in the mid 1990s. So I've been doing this for nearly 3 decades. Over the period roughly that I've been writing, we've seen a succession of financial crises. The Asian crisis, the dot-com crisis, the global financial crisis, and then I'd say the crisis of rising interest rates, which is the crisis we've been in today. And there are several things one can observe about these crises. Is that, for a start, the losses induced by each crisis appear to be larger than the losses of the previous crisis. So the scale of the crisis increases in terms of losses. Scale also increases in terms of geographical reach. That each successive crisis has more and more members. And we call it a global financial crisis, the last financial crisis. But in fact, actually, the emerging markets weren't part of it. It's sort of global emerging crisis. Whereas, I've got a chapter in this book on China, and say that although people don't seem to pay as much attention to as they should, China's economy has become, and financial system has become, hopelessly corrupted by the period of the ultra low rates. So you've got a broader geographical reach, and then another problem is that, and this is actually the worst, is that each crisis is more difficult to analyze than the crisis that came before it. I mean, think of the dot-com bubble. It was, pretty straightforward. A company with no earnings, no sales, with mammoth valuation that would have required, unimaginable sales in order to justify the current valuation. It was never going to happen. So it wasn't very difficult to analyze the dot-com bubble. The global financial crisis is more complicated, and not the US real estate bubble, but the way in which mortgage debt found its way into securitized products, the so-called sort of subprime mortgage securities, and the way those mortgage products were then distributed around the world in French banks or whatever, or in hedge funds, and how and the linkages created by that. So sort of analytically getting your head around a sort of mortgage, a subprime mortgage-backed security, a collateralized debt obligation, was pretty difficult. Now, if you bear this comment I made, that interest interest gets into all the cracks, what it means by that is one really does not know how far this has gone. Now, for instance, I've been doing, I was doing this work. I started this work, the book, back in 2015. I'd been at GMO in Boston prior to that, and I'd done a lot of work on ultra low rates and so on. And I knew, and we all knew, that the pension funds were under pressure from these ultra low rates. Now, I'd read some commentary, and I included it in the book, that some pension funds seem to be taking extra risk in order to make up for this problem, for the problems caused by the ultra low rates. But I didn't know that the pension funds could have been quite as reckless as to take these £1 trillion footings at leverage 7 to 1 in UK long-dated linkers. Now, I also point out in the book, that banks need a healthy carrier, a difference, between the deposit cost and the return on their assets. We all know that, and we knew that the banks were suffering from these very low yields. That was clear. In fact, there was an argument that banks would do reasonably well when interest rates rose because they would have a higher return. But what I didn't know, is that Silicon Valley Bank had a huge inflow of assets in 2020, deposits in 2020, and that it had engaged in unhedged investments, unhedged lever investments in bonds, in US Treasuries, and therefore small movement in US Treasury bonds was enough to wipe out its equity capital and spark a regional banking crisis. So I cite those two instances as cases in which you say, well, one knew something was wrong, but one didn't actually sort of pin. One didn't have enough information to know exactly where the dominoes would fall. So why I say that is that it wouldn't surprise me if problems emerge in areas where we are not expecting problems to emerge. The so-called, what we could call, those are sort of the Donald Rumsfeld unknown unknowns. The second point, or a very generalized comment I make, is this. I don't think the everything bubble has fully unwound. The cryptos lost $2 trillion of value, but they're not quite valueless. Bitcoin is up 50% this year. There's a new little phase of speculative euphoria, fear of missing out in artificial intelligence. I think that, NVIDIA chip maker, it's now $1 trillion company, trading at, I don't know, 100 times sales, something like that. That's not a sign that the bubble is over. The US stock market valuations are in aggregate still way above their long-term mean. US household wealth net wealth came off a bit last year, but it's still way higher than it was at the peak of 2007, far, far higher than at the peak of the 2009 at the dot-com bubble. So all that's to say that in a sort of baseball metaphor, we might be in the third innings now. I was with my old boss Jeremy Grantham last week. He says that all super bubbles, and he would say that 2021 was a super bubble, along with 99 along with 1929 and 99 2000. Every super bubble has a super rally, a bear market rally, and I think the current market rally that's taken the market into so-called sort of bull territory, up 20%, it's low, is just a very conventional bear market rally.
Okay, I'm going to combine two questions. Mark Sashin wants to know if you see a threat to the US dollar going forward from here. And since China may be in your answer, I'm going to combine it with Frederick Brimberg, who would like to know if you'd be gracious enough to expand your thoughts about the Chinese real estate market, or how about China in general?
Let's start with China. I have a chapter on the book on the triple bubble of China, of real estate prices, investment, and credit growth. And as I said in passing, the China real estate bubble, in terms of valuation of real estate relative to GDP, looks to have got to roughly on par with where Japan got to in the late 1980s. But of course, China, a bigger country and a great deal more building in China. So, and Chinese debt, is more than, grew by more than 100 percentage points of GDP since the global financial crisis. And now China does. You can't make easy predictions about what's going to happen in China, because it's not even, it's not a market economy, and losses don't fall in predictable ways. And I was just saying how difficult it is to predict where losses fall in a market or semi-market economy like the ones we live in. So what happens in China is they bury the losses, shuffle them around like wooden nickels through the system, and I don't anticipate a sort of a banking crisis, Lehman style bust up, but I see the bad debt, overinvestment, and real estate bubble in China like a sort of cancer that has metastasized in the system, which will doom China to lower growth going forward. We've already seen that, but I sort of formed this opinion 13 years ago that China's miracle was over, and I think that the events, recent years, and the slow collapse of its real estate bubble conforming to that. The question as to US dollar supremacy is complicated one. I mean, people always predicting the end of the dollar. They've been doing it. I mean, they were doing it. At the beginning of at the end of as Bretton Woods came to an end more than 50 years ago, and for 50 years, dollars remained dominant. And the Americans abuse what I think it was Valéry Giscard d'Estaing called the exorbitant privilege of their position by, first of all, by running up massive foreign debts, so negative net international position. And then more recently, they've abused their position by weaponizing the international payment system for political purposes, which is a dangerous thing to do. However, they still retain a big military, and there are no obvious contenders for that position, because China has a closed capital account, is an authoritarian system with even less respect for property rights than the Americans show on their worst day ever. So, I have a dollar account, and I don't really care if my earnings are in my dollar account. And I bill, probably, even though I'm in Britain, I probably 90% of my earnings are billed in dollars. So, in that sense, I don't see it an imminent threat. And the only caveat I'd say is that currency regimes last for a matter of decades, and the dollar standard, as we call it, is roughly 50 years old. That makes it rather long-lasting. and probably the most likely outcome is a fracturing of the global system into a sort of yuan-based system, dollar-based system, and people are going to have to take that pick. Can I ask? Wait. Can I ask a question to Dick?
Yes.
Look. So the way I see my book, Dick, is complementary to. It's like I see Dick's co-author of the Great History of Interest Rates, and I get particularly annoyed when they say Edward Chancellor has written a history of interest rates. I think someone's already written that book. It's called Homer and Scylla. And I'm not writing about interest. I'm just writing about interest, completely different matter.
Well, I agree that the books are complementary, but our viewers should also know that they'll find your book very interesting to read, and it has provoked a lot of questions that I'm afraid we aren't going to get to. And they'll find my book with Homer to be highly recommended if you're having trouble getting to sleep at night.
No, I think Dick's book. I was thinking before we came in, if I was going to say, the list, I was thinking initially of 10 most important books. Then I thought 5 most important. Now I actually think, and I'm not saying this, Dick, to flatter you. If I was going to list one of the 3 most important books on finance ever written, I would say that Sidney Homer's book is one of them. It may not, it may not be a book you read to your children, but absolutely invaluable. No serious investor or economist should not have that book on their shelves. I've read it twice, 3 times.
It's in its 4th edition, right, Dick?
Yes.
So last question, let's go on. So you see where interest rates are today. You get asked this question from time to time. Are these rates normal, and where do you think interest rates are going?
Oh yeah, well, I get asked that a lot. But a year ago, I mean, they've asked about making a new edition. I'm not so sure that's valid, but I said we have to get through this interest rate cycle because I don't know what's happening. This was back when interest rates were close to 0. Now they're getting to be back what I would call a little bit more normal. So maybe we can think about the latest cycle coming to an end. But David, I think we're about out of time, right?
Yeah, we are. We have so many questions we didn't get to, Edward, but thank you so much for your time. We like to keep these to the tight hour. We could go on for a while. To the audience, we're back in 1 week's time with Cheryl Strauss-Einhorn on Making Decisions, in conversation with our good friend, Professor Paul Johnson. So thanks again for tuning in. Edward, thank you so much for this engaging hour.
Thank you. Pleasure.